Hey everyone, welcome back to Corporate Decoder, the place where we dig into those dusty corporate reports and pull out the juicy bits. Today we're looking at carparts.com Incorporated, and let me tell you, their latest filing is a real roller coaster with more twists and turns than a Formula One race. If you want to know if this company is gearing up for success or sputtering to a halt, stick around. And hey, if you love getting these straight up insights without all the fluff, make sure you are subscribed and join our Discord community linked in the description below for more exclusive content and discussions. Alright, let's dive into carparts.com Incorporated's latest report for the third quarter ending the 27th of September 2025. At first glance, things look a little rough. They reported net sales of about $127 million, which is down nearly 12% from the same time last year. That is a significant drop, meaning they brought in a lot less money, and it gets worse. They also posted a net loss of almost $11 million. Now, losing money isn't ideal, but it is important to see if this is a temporary dip or a sign of bigger problems. Last year, they also had a loss, but this year seems to be a bit deeper. Why did sales drop? The company says it is because they're trying to be more profitable by cutting back on how much they spend on marketing. That makes sense. You don't want to spend $1 to make less than $1, but it also means they're not attracting as many new customers, or perhaps existing customers aren't buying as much. Their gross profit also took a hit, falling by over 17%. This means the difference between what they paid for the parts and what they sold them for got smaller. Their gross margin went down too, from about 35% to just over 33%. Imagine buying something for $100 and selling it for $135. Now imagine selling it for $133. That smaller difference really adds up. They blame this on the mix of products they sold and something called tariffs, which are basically taxes on imported goods. They did try to offset this by raising prices, but it wasn't enough to make up the difference. Now let's look at their operating expenses. These are the costs of running the business outside of just buying the goods. They say these costs went down in the third quarter compared to last year. That is good news. They specifically mentioned that spending on marketing and payroll was lower. This is probably because they cut some jobs, which is never easy. But it can help reduce costs. However, when you look at operating expenses as a percentage of their sales, it actually went up for the year so far. This is because their sales dropped more than their expenses did. So those expenses take up a bigger piece of the pie. They also mentioned some costs related to exploring strategic alternatives, which is corporate speak for looking at selling the company or other big changes. The company also had some other expenses. They had more interest expense this quarter, likely because they borrowed more money. They also saw less interest income, probably because they have less cash sitting around earning interest. Overall, these other expenses ate into their profits even further. Speaking of borrowing money, in September 2025, carparts.com Incorporated issued convertible notes. Think of these as loans that can be turned into company stock later. They borrowed $25 million this way. This is a way to get cash now, but it could mean more of their stock gets sold in the future, which can sometimes lower the stock price for current owners. They also have a credit line with JPMorgan Chase Bank. This is like a flexible loan they can tap into. However, the amount they can borrow has been reduced significantly, from $75 million down to $25 million. This could mean they have less access to funds if they need them urgently. As of the end of September 2025, they had borrowed nothing from this facility, but the reduced amount is something to watch. Now let's look at the stockholders' equity. This is essentially what belongs to the owners of the company. Their total stockholders' equity has gone down significantly. As of the end of September 2025, it was about $64 million, down from over $85 million at the end of last year. A big reason for this decrease is a negative number called accumulated deficit, which is basically the company's total losses over time. This number grew substantially negative, meaning the company has lost a lot of money since it started. This loss also shows up in their net loss per share. For the third quarter of 2025, they lost about 19 cents per share. That is worse than the loss of 17 cents per share. They had last year. For the whole year so far, they've lost 64 cents per share compared to 44 cents per share last year. This means for every share of stock you own, the company has lost more money this year. With these numbers, it is no surprise that carparts.com Incorporated faces a lot of risks. They're heavily reliant on suppliers in Taiwan and China, which brings all sorts of supply chain and trade tension risks. They also depend on third-party delivery services, and any increase in their fees could hurt carparts.com Incorporated. They're also worried about not being able to use their tax losses, called net operating loss carryforwards, which could mean higher taxes in the future. This dependence on suppliers in Asia is a big red flag. If there are political problems, trade wars, or even just shipping delays, it can really mess with their ability to get parts to sell. They mention things like political instability and changes in trade relations. This means their costs could go up, or they might not even be able to get the products they need. Their credit agreement also puts restrictions on them. This means they can't just do whatever they want with their money. They have to follow certain rules. And if they don't, it could cause major problems. The fact that their ability to borrow is tied to a borrowing base means the amount they can borrow depends on the value of their assets, like inventory and accounts receivable. If those values go down, they can borrow less, which could be a problem if they need cash fast. And then there is the stock price. They admit it has been volatile, which is a polite way of saying it is all over the place. They're also worried about not meeting the minimum stock price required to stay listed on the Nasdaq stock market. They've received a notice about this, and if they don't fix it soon, they could be moved to a different market or even delisted. This would make it much harder for people to buy and sell their stock and could really hurt its value. So, what is the big picture here? Carparts.com Incorporated seems to be in a tough spot. They're trying to cut costs and focus on profitability, but that is leading to lower sales and deep losses. Their reliance on foreign suppliers and delivery services puts them at risk, and their credit situation is taut. The stock price volatility and Nasdaq listing concerns add another layer of worry, while they do have a strategy to improve things by upgrading their fulfillment centers and investing in technology. Right now, those efforts haven't translated into positive financial results. It looks like they're in a turnaround attempt, and it is still very early days to see if it will work. They need to find a way to increase sales and manage their costs effectively without sacrificing long-term growth. Alright, that is our breakdown of Carparts.com Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.